Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, David Blanchett explains the importance of flexibility concerning retirement withdrawal rates. Christine Benz talks about how a Biden tax proposal could change how investment gains are taxed for some. Russ Kinnel discusses funds. And we share a high-quality company in the world of Powersports that's considered a bargain. Let's get started. Here are Christine Benz from Morningstar Inc. and David Blanchett from Morningstar Investment Management.
Hi, I'm Christine Benz from Morningstar. Many retirees or soon-to-be retirees have heard the admonition about being conservative about their in-retirement withdrawal rates. Joining me to discuss that topic is David Blanchett. He's head of retirement research for Morningstar Investment Management. David, thank you so much for being here.
Thanks for having me.
David, you have researched withdrawal rates extensively. Let's just start with a basic question. Many investors have heard about the 4% guideline for in-retirement portfolio withdrawals. Do you think that's still a good starting point?
I do. So I guess we can go way back and define all the terms. And so the 4% rule was something that Bill Bengen and others came up with about 25 years ago, or maybe more than that now. And what it suggests is that when you first retire, you can take out 4% from your portfolio and then increase that amount every year for inflation, and it'll last for about 30 years. 4% actually isn't the best name for it because the 4% is only the first year of income. After that, it's a fixed amount. I think 1 divided by 4% is 25 times. Like you need 25 times your income goal when you first retire. Like that's what the rule says. And I'm a big fan of the early research. I thought it was groundbreaking. It's still widely cited. There are some kind of issues that people have with it. It didn't include fees initially, and it was based upon historical U.S. returns. And by any metric, the U.S. has had really good returns historically versus any other country in the world. And there's also questions of, are they relevant today, right? The long-term average yield on U.S. government bonds is close to 5%. For those of you that are aware of the current market conditions, we're not close to a 5% yield today on 10-year government bonds. And so if you rerun the numbers using Bengen's original approach or others, you get a much more conservative initial withdrawal rate, say 3%. That being said, I think it's important to recognize that a lot of the assumptions that's used in this research are really conservative. It assumes that failure occurs if you cannot achieve the same amount of income in today's dollars every year for 30 years. If you fall $1 short, it says that you failed. It fails to kind of acknowledge that people can change their mind, they can change their withdrawal rate, one of other sources of guaranteed income. So I still like 4% as a starting place for the discussion. However, it really is personalized and is based upon kind of each retiree's facts and situation.
Okay. So speaking of that, one other potential sort of limitation to the 4% guideline is that many retirees are further along in their retirement careers and they're seeking a check on whether what they're spending is a sustainable amount. How would you suggest they approach kind of checking up on whether they're taking out too much, too little, and so forth?
So like my favorite rule of thumb for retirees, and this is actually like incredibly efficient, is similar to what you do for required minimum distributions, right? So, you just take one and you say, well, how many years do I want to plan for my retirement to last? And let's say you say, I want to plan for 20 more years. Well, then 5%, 1 divided by 20 is 5%, is actually a pretty good starting place for what you should be withdrawing from that portfolio. Now, it isn't perfect. But if you're planning for retirement to last 30 years and you're taking out 8%, that's not going to be within the kind of margin of safety that would be suggested by that rule.
You have done extensive research on withdrawal rates, and you've already discussed how sensitive advisable withdrawal rates are to what's going on with current yields. Yields have begun to come up a little bit in 2021. Does that affect the prognosis? Could retirees potentially take more if yields get significantly better?
Don't jinx it, Christine. We could go back below 1%. It kind of does, right? And so I think that like the one thing that is kind of wrong with a lot of financial plans is that they assume that you make a decision when you retire and then you follow that path with really out changing it for 30 years. And the answer is yes. Like, if yields do rise, that would suggest you can take more income. But at the same time, like, we don't know what will happen with life expectancies, with the stock market, everything else. And so, the fact that yields are rising, for the most part, it's good news for retirees. However, we just don't know how long it's going to last and what else happens. And so it is good news, but if you're in retirement, you still could have 20 or 30 years to go. So I wouldn't celebrate too much just yet.
Okay. So if there's a common thread among the retirement research that's been done over the past few decades, it's that flexibility is really valuable. If retirees can be somewhat flexible in terms of how much they take out of their portfolio, that can go a long way toward making sure that their portfolios last, and specifically if they can take less when the market is down. A lot of the sort of guidelines related to flexible withdrawals get really complicated. Are there any more simplified ways that you like? You referenced the RMD method. Are there any other ways that retirees can approach tethering their withdrawals to what's going on with their portfolios?
Yeah, so I mean, you mentioned flexibility, and to be honest, that's like one of them, like the most important thing I would say might drive that withdrawal rate. Because if you're someone that like needs a certain amount of income every year, increased for inflation or whatever, without fail, 2.5% or 3% could be your withdrawal rate today. But if you're like most Americans, you say, hey, I got a decent amount of money from Social Security, I can cut back if I need to, then 4 or 5% works. And there's probably almost 2 decades now of research on what are called dynamic withdrawal strategies. How do you adjust the withdrawal rate as you move through retirement? And to your point, a lot of these are really, really complex, and they don't necessarily do a very good job of incorporating like non-constant cash flows and everything else. And so I think that for most people, unless you have access to like a really advanced financial planning software tool, some kind of RMD type strategy where you are thinking, okay, I want to plan this to last X number of years. 1 divided by that number is the base withdrawal rate. That's a really good place to start.
Okay. And the other advantage is that you can update it based on what you anticipate will be your life expectancy. So you can potentially take more as you age.
Right. And obviously the amount adjusts as your balance changes. And, people would say, well, if the market goes down by 30% or whatever, do I have to take out 30% less? No, you can smooth things over time, but just be aware of, hey, if you're following this same path and the markets start going down or something were to happen, you need to be aware of kind of where you're trending in terms of the overall likelihood that your strategy will last as long as you need it to.
Okay, David, it's always great to get your perspective. Thank you so much for being here.
Sure thing.
Thanks for watching. I'm Christine Benz for Morningstar.
Expand your investing horizons and look to the long term with Morningstar's podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Now, Christine Benz and Susan Jabinski from Morningstar Inc. look at the potential impact of Biden's tax proposal.
I'm Susan Jabinski for Morningstar. A proposal from the Biden administration would change the way investment gains are taxed for some investors. Joining me to share some perspective on the proposal is Christine Benz, Christine's Director of Personal Finance at Morningstar. Hi, Christine. Thanks for being here today.
Hi, Susan. Great to be here.
So let's start with some stage setting. Can you sort of walk us through what's in the proposal?
Right. There are 2 main prongs to it. The first would affect the highest capital gains rate. It's currently 20%, 23.8% when you add in the Medicare surtax. It would go up to 39.6% or over 43% once you factor in that surtax. So this is a big jump up. This would only apply to people who have incomes of over $1 million. So if you're selling highly appreciated stock in a year in which your income is over $1 million, you would be subject to this higher tax. The second prong of the proposal relates to what's called the step up in cost basis that heirs enjoy when someone dies and passes on an asset to them. As things stand today, each person who inherits an asset, if you inherit an asset from someone else and it has appreciated a lot since that person initially purchased it, those gains in the security while the person held it essentially get washed away. And your cost basis as the person inheriting the stock is the price of the security on the date of death. This proposal would eliminate the step up for gains of more than $1 million. So those are the two main components of this proposal as we've seen it today.
Now, what would need to happen, Christine, for this proposal to actually become law?
Well, a lot, because it needs to get through a deeply divided Congress. This is a proposal by the Biden administration, but as we know, Congress is pretty evenly split by party and also philosophically. So this proposal has a ways to go before there's any certainty around it, which is one reason why it really makes sense to sit tight, wait for more information, and don't proactively make changes to your portfolio because this may or may not happen.
So even if this proposal is enacted, you don't think it's really going to affect most investors. Walk us through that.
Well, it really won't. So most people, to be subject to this new higher capital gains tax, you'd have to tick two boxes. So you'd have to be selling securities and your income would need to be over $1 million. So that's a rarefied subset of investors right there. Most investors aren't anywhere near that income level. And even if they are, they may have the opportunity to perhaps sell appreciated securities in lower tax years when they come in under that threshold. It's kind of a similar thing with this step up that most people die to the extent that they die and they have assets left over. Oftentimes those would be retirement accounts, which are not subject to capital gains tax rates. And to the extent that they might have taxable assets, well, they probably wouldn't have gains in excess of this 1 million threshold. So this is not going to apply to most mainstream investors. It's generally crafted to affect the very highest income, highest portfolio value investors the most.
So what tax planning or portfolio strategies would you recommend to an investor who may think he or she could actually be subject to this new higher capital gains rate down the road or to the step up in basis?
Right. These proposals generally embellish the case for using retirement accounts first for maxing out those either tax deferred or Roth vehicles, which are not subject to capital gains tax, nor are they eligible for the step up in basis. So we knew that we should be maxing out those accounts, but this proposal, should it become enacted, would really underscore the benefits of doing so. It would also argue for charitable giving to the extent that you're charitably inclined to making sure that you're giving appreciated assets to charity. That makes sense really no matter what the tax regime, but it would be especially beneficial in a higher tax regime where if you're gifting assets to charity, you're essentially able to remove the tax liability associated with those assets from your estate. It also argues for being a bit artful about how you sell appreciated assets, that you'd want to really be thoughtful about disposing of them in years in which you wouldn't be on the hook for this higher capital gains tax. So those are a few different things that you might consider.
Well, Christine, thank you for your time today and for this thoughtful analysis of this proposal. We appreciate your time.
Thank you so much, Susan.
I'm Susan Jabinsky with Morningstar. Thank you for tuning in.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Next, Susan Jabinsky talks funds with Russ Kinnel from Morningstar Research Services.
Hi, I'm Susan Jabinsky with Morningstar. In late April, Morningstar made some changes to the way it categorizes world stock funds. Joining me today to discuss those changes is Russ Kinnel. Russ is Morningstar's Director of Manager Research and editor of Morningstar Fund Investor. Hey, Russ, thanks for being here today.
Glad to be here.
So let's start by unpacking what the changes are and why Morningstar made them.
That's right. We're splitting the world large stock category into three categories by style. So world large value, world large blend, world large growth. Obviously, it's what we've done with U.S. equity and what we've done with foreign equity. Now we're doing it with world stock.
So why right now? Why is now the time to do this with world stock? As you mentioned, we have been doing it for foreign stock funds and domestic stock funds for quite a while.
Yeah, it's nothing dramatic, but I think we are seeing more funds that are specifically dedicated to either the value or the growth side. And then, of course, the last couple of years, we've had really extreme performance by value and growth. And so it sort of magnifies the problem of having them all in together, where you kind of make every growth fund look like a champ and every value fund look like a dud when growth does really well.
So will these category changes have any impact on the analyst ratings that we assign to the world stock funds in general?
Probably not very much, because we already were thinking about them in terms of their own style. We tend to be kind of agnostic and think over the next 5 to 10 years, we don't know if value or growth is going to outperform. So I don't expect it to have a big impact now.
So let's take a look category by category at some of the funds whose longer term returns now look pretty good relative to their peers now that they're in a new category that better fits their style. Maybe let's start with the world growth stock category.
Sure. So growth has been the dominant place even after this nice little value rebound. World large growth funds are returning about 17% annualized over the trailing 10 years versus 7 for value. So growth is still the place, was the place to be. T. Rowe Price Global Stock, American Funds, New Economy, Artisan Global Opportunities are among the very highest returners in world stock.
And Russ, what about some of the standout long-term returning funds in the world large value category now?
Yeah, the impact was really dramatic here. So funds like Oakmark Global and Artisan Global Value have leapt to the top of their peer group from looking maybe above average versus the old peer group, but now they really look like world beaters against both peers and benchmark. And then just below them, it's kind of dramatic to see Dodge & Cox Global and Franklin Mutual Beacon, which their 5 and 10-year returns were a little bit below average before, and now they're top quartile. So it really shows how dramatic that change is from splitting the categories up, and that really highlights funds like Oakmark Global that as well as Dodge & Cox Global, where we think they're really good funds, and now the returns kind of bear that out a little more.
And lastly, how about that group that sort of ends up in the blend category?
American Funds, Capital World Growth Income's a fund that goes from, say, average to a little above average. But the real star is MFS Global Equity, which goes from top third to top 10%. We rate that one gold. And now I think the new categories really highlight that it's a good fund that's does a good job of making the best use of MFS's depth globally, and you can really see that now.
Well, Russ, thank you so much for your time today. It sounds like these refinements are really going to be useful for investors evaluating world stock funds. We appreciate your time.
You're welcome.
I'm Susan Jabinski with Morningstar. Thanks for tuning in.
And lastly, we take a look at a Powersports powerhouse whose shares are on sale.
More than 65 years ago, Polaris started to build its reputation and brand by producing snowmobiles. In the decades since, the company has expanded into all-terrain vehicles, motorcycles, people movers, boats, and, in short order, electric vehicles, building a recreational and utility vehicle powerhouse. Holding leading market share positions in the categories in which it operates has ensured the company's brand remains relevant. We believe that when consumers replace or think about purchasing products in the snowmobile and off-road categories, they tend to want the best products with the newest technology, which is what Polaris provides, yielding stability in pricing and solid brand perception. The company's favorable brands, innovative products, and lean manufacturing support the firm's wide economic moat. Going forward, we expect Polaris will continue to capitalize on its research and development, solid quality, operational excellence, and acquisition strategy to grow demand. Polaris has historically generated top-notch returns on invested capital, including goodwill, and should be able to deliver around 45% metrics by 2030, well above our weighted average cost of capital assumption. While the company is facing near-term headwinds in the form of inflation and logistics costs, as well as supply chain constraints, we think demand stemming from product launches and dealer backfill will allow Polaris to grow sales and earnings per share over the long term. While the second half of 2021 could offer a slower pace of retail sales growth as it laps robust second half 2020 demand, strong wholesale shipments are likely to persist into 2022 in order to close the product shortage gap at retail. Over the next decade, we surmise the company could achieve average sales growth of 5% and earnings per share growth of 11%. We think shares are worth $173 apiece.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.